we are going to discuss about the diminishing balance method. Here, the diminishing balance method, DBM, is also called as reducing balance method or return down value method. As we do the depreciation calculation from the reducing balance in the account closing balance, it is called as reducing balance method. Similarly, it is calculated on the return down value of the asset every year, so it is called as return down value method. Now, it is a method of accounting. Here, as usual, what we had in our straight line method, so direct charge method of accounting is used. Here, the fixed percentage on the book value is charged as depreciation. That is very important. Now, the amount of depreciation is reduces every year by year, because due to depreciation, the balance in the asset account naturally reduces. Also, the percentage also, when we apply the same percentage of depreciation, the depreciation amount also reduces. Here, the formula here is depreciation is equal to opening balance in the asset account multiplied by the rate of depreciation by 100. Now, the asset value will be here reduced to 0. No. Be careful. It will never reduce to 0. Why? Every time we are subtracting as depreciation only a portion of the balance. So naturally, the amount may be very meager, though it becomes very meager, but it will never be closed. So the preparation of accounts here, as I told you in the beginning, is the same as the journal entries and everything are same as the straight line method. So naturally, we need to be careful in depreciation calculation alone. Right? Now, diminishing balance method. Here are the journal entries. Just to have a review of journal entries, here only the amount will vary. All other items are the same what we had in our straight line method. Purchase of asset account, return to bank account, annual depreciation will be depreciation, current year depreciation. Be careful here. Here it is current year depreciation, not the annual depreciation. Now, the next one will be the depreciation of assets purchased during the financial year. In that case also, similarly, the number of, here of course the amount will not change, because this is being the first year, the opening balance will be equal to cost of the asset. So naturally it will be the same in both straight line method and diminishing balance method. Now, the depreciation is provided every year to asset account. Now, it is based on the opening balance in the asset account. This is very important in diminishing balance method. It is based on the opening balance in the asset account. Yes. Now, throughout this lifetime, this policy is to be followed in providing and calculating depreciation. So, the asset account, as I told in the previous slide, it will not be reduced to 0 at any point of time. Okay. Now, here there is the sales entries. Here also, be rest assured that the journal entries are the same. But here, the current year depreciation is to be considered. So, current year depreciation will vary. Be careful, the current year depreciation will vary on the time of sale of the asset. It will not be the annual depreciation, it will be depreciation for that year. So, you have to take into account the opening balance in that year for calculation of this current year depreciation. That is to be reduced to the number of days for it was used during the last year of usage. Now, the second one, sale proceeds. This is a normal entry. And the loss or profit on sale, this is also the same thing. Here, the account is closed at the end of the lifetime when it is disposed of. Here, at the end of the lifetime, it was told, but really, yes, end of the lifetime or when it is disposed of. Either of things must happen to get the account closed. Right? Okay. Now, here is a simple problem. The problem that we had worked out in straight line method, now we are going to do it under diminishing balance method. Depreciation accounting for the year and for the accounting year 31st March 22, purchase price 60,000, so 4,500 depreciation. So for the next year, from that 60,000, we have to deduct this 4,500, and for the balance alone we have to calculate the depreciation. Next, the first year depreciation is less because there is only for 9 months, but in subsequent years it will be for the whole year, so it will be higher. So don't get confused with the see, I have told you already the depreciation will reduce every year, but here it is increasing from 4,500 to 5,550. This is annual. Here if you see the third year, it is reducing, isn't it? So it is called as reducing balance method. Now, here are the journal entries. So first, for the purchase of asset, for the purchase of asset 60,000, and then first year depreciation 4,500, second year 5,500, third year 4,995. So for all the years the journal entries are here. Now we will take up the ledger account. So for purchases, first entry, so every year depreciation is provided and the account is getting reduced every year. The balance, it reduces every year. So only on the balance amount we provide depreciation. Then finally, in the last year we had the closing balance of 377. Right? Now, yes. Now, of course, this amount is to be changed. Just wait. This cannot be like this. This should be only 3,37,62. So this cannot be there here. So be careful. Simply because it is given, don't take it away. So 3,37,162 will be the balance on next year. Of course, here these two entries need not be considered. Now, we will go to the purchase sales problem. The same problem, depreciation, here 2 years, 1920 and 2021. So opening balance onwards calculated as under. See, we have to do it individually for all the years, 17, 18, 19, 20. So for that, we have to work it out. So the asset is purchased on December 26, 10% per annum under return on value method. On June, the plant was sold, costing rupees 2 lakhs was disposed of for 1,40,000. Show the plant account for 2 financial years. So 21 in the sense 1920, 2021. So 2 years we have to prepare. So for 1920, we have the balance of this much. So for that the depreciation will be this much. So this is the depreciation entry. So that depreciation we already entered. Then next year, depreciation. See, this is at that time we dispose of the plant for 2 lakhs. Remaining 50,000, 5 lakhs worth of plant is already with us. So depreciation for sale for up to June 30 is to be calculated. As usual, we have 3 journal entries. For that, we have to separately work it out for 2 lakhs. Then only we can arrive at that balance. See, 1, 2, 3, so 19. So this is the balance and in that balance you have to do it up to the date of sale. So we are the depreciation of 3746 and the remaining balance will be 1,46,104. So these numbers are useful for us. So this is the depreciation amount. For that we have given first entry. We have sold it for 1,40,000. So this is the second one is the sales entry. And now profit or loss on sale. How much? Okay. So that will be 6,104. That is the loss. So profit loss from debtor to plant account. So that will be loss. So these three journal entries we give for sales. And now March 31st, 2001, we are providing depreciation. This depreciation is for the remaining assets. So we will take up that. Depreciation for the remaining part of the plant will be, so 2020, 520 less the book value of the goods sold. So 5245, this is the value for whole asset. But for the asset disposed of, that is 1,49,000. So subtracting these two, we have the value of 3,74,625. For that we provide 10% depreciation. So this will be the closing value in the books of account. So for this 37,463 we provide depreciation for the current year, that is the last year, 31st March 2021. So these are the journal entries. Now we will go to the ledger account. So the journal entries I have given the left side, the accounts are in the plant account. So only these entries are here. So this is the opening balance we have calculated. On that we have provided depreciation. Balance is carried out. This is the opening balance, and for that the remaining asset worth rupees 2 lakhs were disposed of. For that we do three journal entries. One for depreciation, another for sale, another for loss. So remain this slide. Here we have 37,000 credited. So the remaining balance 3,30,162 will be the closing balance. Right? See, this is how. This is what we have seen already in this slide. Okay. So be careful. These are all about the purchase sense problem in case of written down value method. So we must be very careful in doing calculations under written down value method. Wherever necessary, do the calculations from the beginning, as I have shown you already in the previous slide. Thank you.